Ever pondered on how to begin investing? Maybe you've considered it but always felt a bit intimidated by the jargon and the perceived complexity. Investing, as we know, can seem like a daunting task. You might have heard of stocks, bonds, mutual funds, and maybe even cryptocurrency. These terms can make your head spin if you don't have the right guidance or knowledge about them. Some people let the fear of the unknown keep them from taking the first step. But let me assure you, with the right resources and a little bit of patience, anyone can start building wealth. Investing is not just for the financial whizzes or the privileged few. It is a journey accessible to anyone willing to learn and take calculated risks. Take a moment to imagine what it would be like if money could work for you day and night, even while you sleep. That's the power of investing. Welcome to Financial Education, your financial guide. Our mission is to break down these complex concepts into simple, understandable language. We believe in empowering you to make informed decisions about your money. In our series, we'll walk you through various investment strategies, explain different financial instruments, and give you a rundown on market trends. We'll also share tips on risk management and how to build a diverse portfolio. Our aim is to make you confident and savvy about your financial decisions. Today, we're going to demystify the process and get you on the path to financial success. So sit back, relax, and let's embark on this exciting journey together. First things first, you need to define your financial goals. This is the very bedrock of personal finance. You might be wondering, what does it mean to define your financial goals? Simply put, it is to envision the course of your financial journey, to dream up your future and to where you want to see yourself financially in the next decade or so. It's about asking yourself some important questions, like what do you want your money to do for you? Think deeply about this question. It's not just about accumulating wealth, but about something meaningful with your finances. Maybe you're saving for a down payment on a house. This is a common goal for many people. Home ownership is often seen as a significant achievement, a sign of stability and success, or perhaps you're looking towards a comfortable retirement. This is another long-term goal that many people share. The idea of being able to relax and enjoy life without worrying about work or finances is indeed attractive. To get there, you need to start planning and saving early. The question is, how do you achieve these goals? This is where financial planning comes into play. Once you have your goals in mind, it's time to assess your risk tolerance. This is an important concept in investing. In simple terms, risk tolerance is how much risk you are willing to take on in exchange for potential returns. Are you comfortable with high-risk, high-reward investments? These types of investments could potentially give you higher returns, but also come with the chance of loss. Think of stocks or cryptocurrency. They can skyrocket in value, but also plummet. You could make a fortune, or you could lose everything. Or do you prefer something a bit more stable, like bonds or mutual funds? These types of investments typically provide a steady stream of income over time, albeit smaller compared to high-risk investments. They're generally considered safer. But remember, even these carry a certain level of risk. So take your time, do your research, and consult with financial advisors, if necessary. Understand what each investment type means, learn about market trends, and consider how it fits into your financial goals and risk tolerance. Remember, all investments carry some level of risk, but knowing your comfort zone is key. Next, consider the time frame for your investments. This is a critical aspect of financial planning, as the period you plan to stay invested significantly impacts your financial returns. Short-term investments are a category of investments we need to talk about. These are investments that are typically held for a relatively shorter, usually 1 to 3 years. Short-term investments can include options like money market investments, savings accounts, or government bonds. These are generally lower risk and provide a stable, albeit often lower return. They are ideal for investors looking for a quick turnaround or those who are risk-averse. Now let's switch gears and talk about long-term investments. Long-term investments stand on the spectrum. They are generally held for a much more extended period, sometimes for several decades. These can include assets like real estate, stocks, mutual funds, or retirement accounts. Long-term investments usually bear higher risks, but also the potential for higher returns. They can be a good fit for those who are willing to risk short-term volatility for the potential of greater gains. It's a classic case of high risk, high reward. However, the type of investment you choose should not be selected merely based on the potential return or the risk associated. It should align with your financial goals and risk tolerance. For instance, if you're saving for a short-term goal, like buying a car in 2 years, short-term investments would be more suitable. Conversely, if you're saving for retirement, you'll want to consider long-term investments. Ultimately, the type of investment you choose will depend on your financial goals and risk tolerance. Now let's dive into the different types of investments, an exciting world of financial opportunities and a playground for financial growth. In this vast expanse of investment options, there are 3 key categories we shall explore today: stocks, bonds, and mutual funds. Let's start by getting a better understanding of what each of these investment vehicles is. Stocks, for those who might be unfamiliar, essentially represent ownership in a company. When you purchase a stock, you are buying a tiny fraction of that company, making you a shareholder. Being a shareholder means that you have the potential to participate in the company's fortunes. If the company does well, its stock price could rise, providing you with potential high returns on your investment. Stocks are exciting, they're dynamic, and they can be incredibly rewarding, but the flip side, they also come with a higher level of risk. This is primarily because the performance of stocks is intrinsically linked to the company's performance, which can be influenced by a multitude of factors: market conditions, industry trends, company-specific news and events, and more. When these factors are positive, the stock can soar, but when they're negative, the stock can plummet. On the other end of the spectrum, we have bonds. Bonds are more like loans you give to a company or government entity. When you purchase a bond, you are lending money to the issuer of the bond, who promises to pay you back with interest over a specified period of time. Unlike stocks, bonds aren't about ownership, they're about lending, making them a debt instrument. The allure of bonds lies in their reliability. They offer lower returns than stocks, but are generally considered more stable, secure, and predictable. Investing in bonds can be likened to a steady, slow and steady wins the race kind of journey. Then we have the hybrid option, the best of both worlds, if you will, mutual funds. A mutual fund is a collection of stocks, bonds, assets managed by a professional fund manager. Mutual funds offer diversification, which can help spread out risk. They give you the opportunity to invest in a wide array of securities at one go, without the need to research each individual company or bond. Remember, a well-balanced portfolio typically includes a mix of different asset types. This is called asset allocation and is a critical part of investment strategy. A wise investor knows to balance out the high-risk, high-return potential of stocks with the stability of bonds, while also leveraging the diversification benefits of mutual funds. This way, one can strive to optimize returns while managing risk in a calculated manner. So, how do you actually start investing? You'll need to open an investment account, which can often be done online. Look for a reputable brokerage with low fees and good customer service. Once your account is open, it's time to research and select your investments. There are plenty of resources available, from financial news sites to investment blogs and forums. But remember, it's important to do your own due diligence. Don't just follow the crowd. Make sure you understand what you're investing in and why. As the old saying goes, don't put all your eggs in one basket. Diversification is key to managing risk and achieving long-term financial success. And there you have it, a basic guide to starting your investment journey. Remember, investing is a marathon, not a sprint. It takes time and patience, but the rewards can be well worth it. You're now equipped with the knowledge to begin your investment journey, so go out there and make your money work for you.